All right, let's go ahead and get started. Good morning and welcome to today's Tuesday Market Outlook. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I'm going to be giving you my thoughts and analysis on the broader market. So just before we get started, our quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, we'll be kicking off with the major equity indices, highlighting a few key levels. We're actually seeing broadening participation despite technology slightly underperforming, but overall the other sectors seem to be holding up very well, which is why the S&P and the Nasdaq continue into new all-time high territory, even though they are at risk of a pullback once again. So we'll take a look at potential support levels in terms of where price could pull back to. From there, we'll be moving on to fixed income and commodities. We'll take a look at the sector rotational model as well, highlighting which sectors are outperforming and underperforming the broader market. We'll take a look at a few subsectors of interest, and we'll end today's webinar with some bullish and bearish market observations. Starting off here with the S&P 500, using the SPY ETF. So price has rallied here. It's now well above 500 at 506, but the last two sessions have seen a slight pullback, some bearish price action, but the bullish structure still remains quite strong, especially when you look at the weekly time frame. You can see just the magnitude here of how much of a bullish move price has made in the last few months. So like I said before, these minor pullbacks are going to be good buying opportunities. We know when it comes to interest rate trajectory, we'll still get potentially multiple interest rate cuts for the year. However, on the negative news side, when it comes to interest rates, we know that the March meeting is going to be a high probability of not getting a interest rate cut. Interest rates do look set to be staying put in place between 525 and 550 basis points. And, that's a big shift from, even about 2 months ago, where there was around an 80% probability of a 25-point cut. We're just not seeing that happening now with Fed futures pricing in pretty much only a 2% probability. So despite that move all the way down when it comes to the interest rate cut probabilities, price has still managed to continue higher, even though it did consolidate slightly above 470. Overall, price is still maintaining a lot of momentum, which does speak to the fact that we are still very much in a risk-on environment, and broadening participation is helping with this equity rally, but also the AI boom. The AI boom still seems to be going strong. I wouldn't say, is it a bubble? Is it not a bubble? In my opinion, it's difficult to say. I mean, AI is one of those things which is already directly impacting businesses and improving efficiency and productivity in many ways. So I do think that AI is definitely here to stay. Could the move be in the short term be a little bit exaggerated? Potentially. So potentially we could see that pullback. But for now, I wouldn't bet against the AI boom. It definitely seems different to other bubbles, if I can use that word, because I don't necessarily view this as a bubble, but it definitely seems different to the likes of the Bitcoin bubble that we had, which was maybe the more recent one. And of course, the pandemic bubble where we saw valuations hitting crazy numbers. I think the AI boom seems to be a little bit more solid. And we are seeing that play out here for the major indices continuing higher. Support zones to be looking at 500 as a psychological level, if we do expect to see a limited pullback, but if we expect to see a bit more of a deeper pullback, 490 would be the next area that I am looking at. These two levels to the downside. I don't want to really wait for price to hit all the way down to this more major support at 470, because that's quite a big decline. And if you're waiting that long for price to decline before buying, you may not actually be able to get into the market at all, because if you look at the price action in the last few weeks, the pullbacks have been very, very limited. And moving on to the Nasdaq 100. So the Nasdaq 100 price just shy of that 440 level. Again, showing some bearish price action in the last two sessions, but very limited. I would say this is more neutral than bearish because bullish structure still remains strong with price forming higher lows and higher highs, obviously. Momentum is still very good here on the 50-period CCI, which has been positive since really early November. So there's no red flags to say here for the Nasdaq 100. The one thing I did notice was maybe some negative divergence on the weekly time frame. But again, the fundamental and the macro picture does outweigh this technical indicator. So I would say for the Nasdaq 100, even though technology right now is going through a bit of a breather, as a sector, and the Nasdaq 100 is heavily linked with technology. I still think that this is a very good bullish bet, especially for the long term. And those potential pullback zones like 420 maybe as a potential area, maybe even 430 if we get a very limited pullback. Those would be the levels that I would be looking at. The one thing I forgot to mention with the SPY chart was, of course, non-farm payrolls coming out. That number is coming out next week, but this week we do have some PCE numbers. So that'll be a good indicator that the Fed will be watching. So we'll keep an eye on that. IWM, the Russell 2000 ETF, price bouncing from 188, still within the range between 188 support, which was a 38.2 fib, and a 23.6 fib, which is a 210 area. Not even really getting to that 23.6 fib just yet. Although it is set to open a little bit higher, we're seeing signs of outperformance in the last couple of weeks, indicating again the extent of the risk on rally that we're currently experiencing. But still, it is limited somewhat by these resistance zones. So the next key level would be on the daily time frame at 206, but the major level that I am looking at is 210. In my opinion, bullish structure is quite strong. We've had the big impulse move to the upside, followed by a retracement lower, staying above 38.2 fib level at 188, which was critical. And now we are seeing a continuation higher, but with maybe less momentum than what we saw at the beginning of the rally when price bounced higher from the low 160s. TLT, the Treasury Bond ETF. So TLT was holding some support here around the 94 level. It was holding it quite firm, but then we saw a breakdown, and we're seeing a bit of a retest here once again, showing some bearish price action yesterday. So let's see if price can actually break back above this 94 level, because that is still a good support zone here for TLT. Overall, I do think TLT will continue higher throughout the year. But it is experiencing a pullback as yields have actually gone on to move higher, and the probabilities of that March interest rate cut has been cut. So that is why we are seeing this significant pullback in TLT, but I wouldn't say we're going to be seeing that much of a decline moving forward. We may get maybe a bit more of this pullback, as you can see, after this impulse move, it doesn't look like price is exactly reversing lower with a lot of bearish momentum. Momentum did turn slightly bearish, but it does already seem to be picking up. So keep an eye out on TLT. Longer term wise, right now, this entry point does give a good risk reward bullish entry for continuation higher. But this is a chart that's going to be very sensitive to anything interest rate related, especially things like inflation, CPI numbers, and jobs reports. Okay, the US dollar has actually seen a bit of a decline here in momentum. As you can see, momentum has been declining. Price has been kind of declining as well, but in a very choppy fashion. So it's not a big bearish move to the downside. And if yields continue to move higher or stay at elevated levels, I expect to see the dollar index, stay neutral, maybe above 103. The major level on the weekly time frame is definitely this 105 area. Price was struggling to break above that, as you can see. But for now, it is somewhat directionless. And yeah, yields, again, are also a little bit more neutral in the last couple of weeks, which is why we're seeing that. But again, anything interest rate related will see a huge shift in the US dollar. Okay, moving on to gold. So gold has been once again quite choppy. Although last week, we saw price actually bouncing higher from this 184 level. So it was a good entry point, but we can slowly see that price, after being very bullish, is starting to go a bit more neutral, with some capitulation potentially, especially with this 192 level acting as a major multi-year resistance zone. So price unable to break above that. Momentum now in the negatives, but maybe a bit more closer to neutral. And even if we do get a move up higher, like I said before in the last few weeks, risk reward does actually still favor the downside. So the sentiment here is definitely shifting, or it has already shifted from bullish to neutral. And oil, so light crude oil futures, again, a lot of choppy price action, but it's at a key level here at 78. And the last few times the price has reached this level, we've seen an immediate rejection lower. We're not really seeing that just yet. We're seeing a lot of consolidation, price in a very tight intraday range between 76 and 78. And this actually provides some encouragement that we could see a breakout here and continuation higher for oil, for those of you that are bullish on oil. We're not seeing the bearish price action. And that's why, even though price is at this resistance zone, the price action here leads me to believe that it's not a good time to actually enter in a bearish play. I agree that before you could pretty much play the range, you could use credit spreads to take advantage of that time decay working in your favor and play the range. But right now, the price action isn't, even though the credit spread would still be profitable in this neutral market environment, the fact that price isn't rejecting the 78 level and immediately moving lower does indicate to me that there could be some momentum here to see a potential breakout and push higher. Okay, for the sector rotational chart, I did make a bit of a mistake here with the sectors on the left, on the categories on the left-hand side. So just ignore that for now. My PowerPoint did not save. But yeah, the sector rotational chart, 9 sectors in the improving and leading categories and 2 in the lagging and weakening. So lagging category, we still have technology. It was showing some signs of making a rebound last week, and that seems to be dissipated, moving from the weakening to the lagging category here and continuing to really weaken against the broader market. It may not be a bad thing, it's helping with broadening participation. And what I find very encouraging is the fact that the rest of the sectors, because of the broadening participation, are allowing the major indices like the S&P to continue to push higher. This is a healthy market rally. This is signs of a healthy rally. What we saw during the pandemic recovery period was technology in this leading quadrant for months at a time. Every other sector in the lagging or the weakening quadrants hardly ever getting into the improving, let alone the leading. And the leadership was so incredibly narrowed. So it didn't indicate a healthy rally, hence why we've got the crazy valuations, and hence why 2022 was such a bear market. Whereas now, I think this is a bit more healthier. I don't think it'll be a long time before we start to see technology find some momentum again. But remember, it also has been providing a lot of leadership, especially since early November for the broader markets. So it does make sense that we're seeing some outward rotation here. Our defensive sectors in healthcare, which is in the leading category, staples and utilities also seem to be performing well with the absence of technology rotation. And we're seeing energy slide its way into the leading category, again, due to elevated crude oil prices, potential breakout there. So keep an eye out for energy stocks as well. So moving on to some subsectors of interest, we have LIT, the Lithium and Battery Technology ETF. This was a name we looked at last week. We were hoping for a continuation higher, upside target of 46, a conservative target, and then potentially even that $50 level, which was a upper bound of that range. Now, we did see a move higher, followed by a bit of a pullback, and price is pretty much dead neutral from where we discussed it last week. So this thesis is very much still intact. I'm looking for the continuation higher back to 46. But again, no big update just yet. However, the one thing I want to point out is a positive divergence here on the weekly time frame. Price making a lower low, momentum making a higher low. This is a very bullish indicator, at least from a technical perspective. So let's see how this plays out in the next few weeks. KRE, the regional banking ETF. So KRE, we were bullish on this last week. Price hasn't really performed that well. It's been grinding lower. Okay, not a lot of bearish momentum. As you can see, it's been intraday trying to push higher and it's failed. But I would say the downside here could be capped at around 46, major support level. And there is still room to the upside towards the 54 area. So thesis is still intact. If price breaks below 46, that's when you'd want to cut losses on this trade. But for now, KRE ever so slightly moving against us. Okay, so Intel has been quite neutral. I was looking for this bullish breakout here last week. Hasn't quite happened, but still staying above that 42 level at around 43. So it's still quite encouraging for me. Again, going to keep this position open. I don't see any reason to close it just yet. Maybe a bit more patience is required. But once we get to a break down below that 42 level, that's when you'd probably want to close out this position. But for now, there's still a nice gap fill opportunity for Intel. Newmont Corporation. So Newmont, this was a trade idea that went against us because we were looking for a rebound here last week from price, dipping to below that 33 level. And initially we were getting that, but that's definitely been invalidated. We've seen a big move to the downside here. This has a high correlation or used to have a high correlation with gold prices, but the valuations were deemed a little bit too high at the time, which is when we saw the break of correlation and continuation lower, despite gold moving higher and staying at elevated price levels. I do think in the near future we will get a good rebound here for Newmont because it is getting to a bit more of an undervalued range. But for now, in terms of the timing for this trade, just wasn't great. So this would be a name that you'd want to cut losses on, and if you haven't already done so. C Limited still going quite well, grinding higher and approaching the top part here of our take profit zone. We're really on the weekly time frame, it doesn't really paint an accurate story, but I think the daily time frame is probably what you want to look at because we're really looking at this range between 48 and 35. We entered in prices at around 37, 38, and has continued higher here. So now's a good time to take full profits. I know we said taking partial profits at around 42 was a good idea. But full profits anytime now between 46 and 48, I think would still work fine. And a new idea for today is Apple. So I'm really liking Apple at these current levels because what we've seen here was a big impulse move. Momentum has died down, there's no doubt about that, but we're not really seeing a breakdown or a very strong breakdown. And the reason I say that is because this 180 level of support is still holding quite firm. So Apple, with price now once again reaching this level, the risk to reward actually favors the upside quite nicely. And you don't want to be bearish on Apple for too long. So I do think now is a good time to enter maybe a credit spread, a put credit spread to take advantage of this potentially bullish move. And again, the risk to reward is optimal for maybe even a more aggressive entry point as opposed to simply waiting for additional bullish confirmation. Okay, with that is all I have for you today. Just a bit of housekeeping, so everyone knows I will be leaving Options Play at the end of this month, so this is my last market outlook. I just wanted to say a big thank you to all of you. It's been a privilege to be able to be here every week to talk about what I really enjoy talking about when it comes to markets. I hope that you all enjoyed it as well. And yeah, I mean, just wanted to say thank you. Um, I think Tony will be resuming the market outlooks from next week, so you will still get weekly market outlooks. But Firstrade and Options Play will be in contact with you. Again, guys, thank you so much for giving me this opportunity. It was great.